The American monetary system is a complex but fascinating framework that governs how money is created, circulated, valued, and managed in the United States. Rooted in historical developments, such as the establishment of the first Bank of the United States in 1791, today's system operates through a combination of fractional reserve banking, government institutions like the Federal Reserve and U.S. Treasury, and market dynamics. This essay provides an easy-to-understand, comprehensive summary of how the current U.S. monetary system works, emphasizing money creation, credit and debt, currency valuation, government involvement, and market fluctuations. By drawing on historical context and incorporating clear explanations, this educational overview aims to make the system accessible to all while remaining broad, unbiased, and detailed where necessary. The foundation: fractional reserve banking. At the heart of the American monetary system is fractional reserve banking, a practice formalized in 1791 with the first Bank of the United States in Philadelphia. This system allows banks to lend more money than they hold in reserves, creating new money in the process. Banks are required to keep only a small fraction, typically around 10% or less, of their deposits as cash or reserves, as mandated by the Federal Reserve. The rest can be lent out, multiplying the money supply through a cycle of lending and depositing. For example, when someone takes out a $100,000 mortgage to buy a house, the bank credits their account with $100,000, creating new money. The home seller receives this money, deposits it in their bank, and that bank can lend out a portion of it, say $90,000, creating more money. This process continues, expanding the money supply, which reached $21,560 billion in January 2025, according to the M2 measure: cash, checking accounts, savings, and other liquid assets. This money creation applies to loans for both tangible assets, like houses, and consumable goods, like a $1 pack of bubblegum bought with a credit card. Before 1791, U.S. banking was decentralized, with local banks acting as vaults for gold and silver, lending only from reserves. Borrowing was limited, often for trade or land, as many could homestead without loans. The first bank introduced a standardized system, issuing reliable banknotes backed by the government, unlike the varied and often counterfeit-prone local notes. This marked the beginning of a national approach to money creation, setting the stage for today's system. Money creation: loans, credit, and debt. Money creation in the U.S. primarily occurs through bank lending. When you borrow money, whether for a house, car, or credit card purchase, the bank doesn't lend pre-existing cash but creates a new deposit in your account. This deposit is money, accepted by sellers and banks alike. For a mortgage, the loan is secured by the house, which can be repossessed if you default, providing stability. For a credit card purchase, like bubblegum, the debt is unsecured, relying on your promise to repay, which carries more risk. This lending process drives economic activity. When you buy a house, the seller spends the money, boosting businesses and generating tax revenue, which was $4,900 billion in 2024. However, each loan increases the money supply, potentially devaluing the dollar if money grows faster than the economy's output, its productive capacity. Excessive lending, especially for consumables, can lead to inflation, where prices rise as dollars buy less, as seen historically in cases like Weimar Germany. Credit and debt are integral to this system. Household debt, including mortgages and credit cards, totaled $20,400 billion in 2024, while business debt was $21,600 billion. Banks profit by charging interest on these loans, earning money on the debt they create. The cycle of borrowing and repayment keeps the economy moving, but overlending risks financial crises, like the 2008 housing bubble, when defaults on mortgage-backed loans destabilized markets. The Federal Reserve, the central bank. The Federal Reserve, established in 1913, is the U.S. central bank, overseeing the monetary system to promote stability and growth. It replaced earlier national banks, like the First Bank, 1791 to 1811, and Second Bank, 1816 to 1836, which faced political opposition, leading to a chaotic period of local banknotes until 1913. The Fed regulates banks, sets monetary policy, and manages the money supply. One key tool is open market operations, where the Fed buys or sells U.S. Treasury bonds to influence the money supply and interest rates. When it buys bonds, typically from banks in the secondary market, it credits their reserve accounts, creating new money. This increases liquidity, encouraging lending and lowering rates, which were between 4.75% and 5% in 2025. Selling bonds reduces the money supply, raising rates to curb inflation. The Fed also sets reserve requirements, ensuring banks hold enough cash to cover withdrawals, stabilizing the fractional reserve system. The Fed determines how much physical currency is needed, instructing the U.S. Treasury to print Federal Reserve notes, the dollar bills we use. It distributes these to banks to meet demand, ensuring enough cash circulates for transactions, a small fraction of the $21.560 billion money supply, as most money is digital. The U.S. Treasury, printing money and collecting taxes. The U.S. Treasury plays a complementary role, housing the Bureau of Engraving and Printing, which produces physical currency per the Fed's orders. The Treasury's Secret Service combats counterfeiting, ensuring the dollar's reliability. The Internal Revenue Service, IRS, collects taxes, which fund government spending alongside borrowing. In 2024, tax revenue fell short of spending, contributing to a $1.9 trillion deficit, necessitating borrowing through Treasury bonds. The Treasury issues bonds, notes, bills, and bonds to cover deficits and refinance old debt, totaling $45.5 trillion in 2024, with $36 trillion as the national debt. These are sold at auctions to banks, individuals, and foreign governments, with interest rates set by market demand and influenced by Fed policy. When the Fed buys bonds, it creates money, expanding the money supply and holding these bonds as assets, effectively lending to the government. Government borrowing and bonds. Unlike individuals, the government doesn't borrow from banks or use credit cards. It issues Treasury securities. When spending exceeds tax revenue, the Treasury borrows by selling bonds, promising to repay with interest. These bonds fund everything from infrastructure to social programs. Financial institutions buy bonds, holding them as safe investments, while the Fed's purchases inject money into the economy, stabilizing markets by maintaining bond prices and preventing sell-offs at a loss. The national debt's growth reflects cumulative deficits, with interest payments a significant expense. Critics argue this debt, financed partly by money creation, risks inflation, but others see it as sustainable, given the dollar's global trust. The Fed's role in buying bonds, especially during crises like 2008 or 2020, underscores its power to manage economic fluctuations, though it must balance growth and price stability. Currency valuation and market fluctuations. The dollar's value is determined by supply and demand, influenced by the money supply, economic conditions, growth, unemployment, inflation, and global trust. In 1791, the money supply was $10 to $15 million, tied to gold and silver under the Coinage Act of 1792, which set the dollar as a silver-based unit. By 1913, it was $20 billion, and in 2025, $21.560 billion, reflecting a fiat system untied to commodities since the 1971 end of the gold standard, $35 per ounce. Too much money creation, from loans or Fed bond purchases, can devalue the dollar, causing inflation. Conversely, too little can slow growth, raising unemployment. The Fed adjusts rates and money supply to balance this, but market fluctuations, stock crashes, housing bubbles, or global crises complicate efforts. The U.S. net worth, $150 to $200 trillion in 2025, includes $48.2 trillion in real estate, showing wealth far exceeds the money supply, but currency value hinges on confidence in the system. Globally, the dollar competes with currencies like the euro and yuan, part of a $100 to $115 trillion global money supply. Its status as a reserve currency, held by foreign banks at $8 trillion, bolsters value, but trade imbalances or geopolitical shifts can weaken it. The Fed and Treasury work to maintain trust, but fluctuations are inevitable in a dynamic economy. Strengths and challenges. The U.S. monetary system's strength lies in its flexibility. Fractional reserve banking fuels growth by expanding credit, supporting businesses and consumers. The Fed's tools, rates, bond purchases, reserves, allow rapid response to crises, while the Treasury's tax and borrowing mechanisms fund public needs. The dollar's global acceptance enables trade and borrowing at low rates, sustaining a $25 trillion economy. Challenges include inflation risks from overlending, inequality from debt access, banks profit while some struggle, and debt sustainability, with $45.5 trillion owed. Historical crises, like the 1836 to 1913 lack of a central bank or 2008, show vulnerabilities. Alternative systems, like full reserve banking, no money creation, or gold standards, offer stability but limit growth, highlighting trade-offs. Proposals to restrict money creation to real property, like land, could curb inflation but reduce consumer spending, which drives 70% of GDP. Historical context for clarity. The current system evolved from necessity. In 1791, the first bank stabilized a fledgling economy, replacing chaotic local notes. The 1913 Federal Reserve Act addressed 19th-century banking panics, standardizing currency. The 1971 shift to fiat currency enabled flexibility, as gold's fixed supply constrained growth. Each change addressed specific needs, stability, expansion, or resilience, shaping today's system, which balances competing goals in a globalized world. Conclusion: a dynamic, imperfect system. The American monetary system is a dynamic interplay of banks, government, and markets, creating money through loans, managing it via the Federal Reserve, and funding it through taxes and bonds. It supports a vast economy, with a $21.56 trillion money supply and $150 to $200 trillion net worth, but requires careful oversight to avoid inflation or crises. By understanding how banks create money, the Fed stabilizes markets, and the Treasury funds government, we see a system that, while imperfect, adapts to modern needs. Its complexity reflects the challenge of balancing growth, stability, and value in a diverse, ever-changing economy.